Hello, everybody. My name is Alex Koldovsky. I'm the CEO of ProTitle USA, Doc Solution USA, and One Diligence LLC. If you follow my YouTube channel or LinkedIn channels, I analyze the bank failures and possible stress in the market that can cause the next wave of bank fails. I'm extremely lucky to have a very special guest, a true expert with me today on the banking system health. I know just a little, and I know my guest knows quite a bit, and I'm hoping he'll give you a lot of insights on what's going on. This guest is John Como. He is the policy economist for Council of Federal Home Loan Banks in Washington, D.C. John has degrees from Cornell University, the State University of New York at Plattsburgh, and is the Chartered Financial Analyst, CFA. Over the past two decades, John has served at the U.S. Department of Housing and Urban Development, the Federal Housing Administration, FHA, the U.S. Treasury Department, and U.S. Bank. Through these roles, John had primarily focused on intersections between housing economics, mortgage finance, federal government programs, and banking. John, welcome to the podcast series.
Great. Thank you so much for having me, Alex. Happy to be here.
Oh, my pleasure. So me and John met quite a while back, I'd say about 10 years back, when I was visiting a HUD office in Washington, D.C., and John really impressed me with his knowledge of the market, and I'm hoping that he can share with us all the insights of what's going on in 2023, 2024. And, to tell the truth, Federal Home Loan Banks, for me, is yet another government branch that is similar to FDIC or NCUA, right? So maybe I'm wrong. And I'm hoping that John can walk us through on where Federal Home Loan Banks play. I always think of them as the last resort lender for many banks, but not all banks. So for me, it's a bit confusing, and I'm hoping, John, can you explain the role and I guess the market space where Federal Home Loan Banks play?
Sure. Yes. Happy to do that. So there's, as you mentioned, there's lots of confusion about the Federal Home Loan Banks and exactly what role they play and how they fit into the U.S. financial system. And so I've now been at the Council of Federal Home Loan Banks for about 4 months. And like you mentioned previously, I was at Treasury working on their housing programs. So part of the problem with the Federal Home Loan Bank in understanding what we do is the name. So it says Federal Home Loan Bank. So we're not federal. It's the Federal Home Loan Banks are chartered by Congress, but we're independent. The system consists of 11 separate banks. So sort of like the Federal Reserve System that has 12 regional Federal Reserve banks. The Council of Federal Home Loan Banks has 11 independent banks that, together with the Office of Finance, constitute the overall Federal Home Loan Bank system. And we are a government-sponsored enterprise, so similar to Fannie Mae and Freddie Mac. As it turns out, we're the one GSE that did not go into conservatorship in 2008. It was a stress time for everybody, but the home loan banks made it through that time in slightly better fashion. So we're chartered by Congress. We're a private entity with a public mission, which is to provide liquidity to our members and in support of housing and economic development. So there's a lot going on there. So the system right now has about 6,500 members, and our members are commercial banks, credit unions, thrifts, insurance companies, and CDFIs. And we're all across the nation, I think in all 50 states, plus DC, plus 3 territories. So we go all the way out to Guam and down to Virgin Islands.
John, just to clarify, the member banks, are they also insured by FDIC, or that's a completely separate sort of overlay?
Completely separate. So so we sort of like when there's a bank runs into stress or problems, like the federal home loan banks work with the FDIC, work with the Federal Reserve and other regulators for like orderly resolution of banks. So in order for a bank to be a member of the federal home loan banks, it has to be overseen by a federal or state regulator. So FDIC insured banks are members of the federal home loan bank system.
Okay.
And our primary role is to provide liquidity. So, and we're collateralized lenders. So banks will come to us, post collateral, and then we issue what we call advances for routine operations or for specific projects that they need to fund.
Okay, understood. So let's dive into a few things that I wanted to ask. So first, let's look at the past, right? We saw some bank failures in March of 2023. SVB Signature failed, and that was a pretty massive cleanup that's still going on with FDIC sales of some of the commercial assets there. How did Federal Home Loan Bank system come out of 2023? Did you see the same level of stress in March?
So 2023 was a very interesting year. As we started the year, advance volume was increasing. So that's, again, those are the loans that we provide to our members, the funding to our members. And then in the spring, as SVB and Signature failed, there was huge demand. So as you may recall at that time, the Wall Street Journal and USA Today were running articles about who's going to fail next. Is there going to be a contagion? There was a research paper out of USC in Columbia saying that up to 190 banks had similar issues and could be next in line to fail. And so at that time, there was lots of concern by depositors and lots of concern amongst banks and regulators. So our members wanted to shore up their balance sheets and came to us for advances. So the Federal Home Loan Bank system, there was a week, I think the week of March 8th maybe, or maybe March 13th, we had our biggest single week of advances in the history of the system. So the system was started in 1932, but we had a single week in March of 2023 when we had over $675 billion in advances. So it was a huge, huge week. And over the course of the first quarter, when we posted our first quarter results, we showed that for the first quarter overall, we issued advances that were up 350% from the period the prior year. So there was just a huge demand on the system, and we largely met those demands and provided liquidity to all of our members. So there's obviously a focus on the banks that failed at that time. During that period, I think we had somewhere around 3,700 members that took out advances, and I think there were 2 or 3 that failed. So the failure rate of Federal Home Loan Bank members that had advances is 0.00 0.05%. And the vast majority of our members, we were able to help and to get through those stress periods there.
And what happened with those 2 that failed? Are those the ones that the FDIC took over?
Yes. So those are the ones that FDIC took into receivership. So during that period, so as you may recall, so SVB in particular, I think was the first one to fail. I wasn't with the home loan bank system back then, but I remember seeing it in the news and looking at the reports. They had a number of things that led to their failure. One primary was they had a really high share of uninsured deposits, as you may have seen. So they're looking across the banking system. So the U.S. has one of the most diverse banking systems in the world. So I think like in the U.K., for example, they have around 115 banks that are based in the UK that are headquartered there. We have more than that just in the state of Kansas. So we have, and again, the system has over 6,500 members. Across the banking system in general, most banks have around 45% of their deposits are uninsured deposits. SVB, I believe, had around 92%. So,
but what does it mean uninsured? It means over 250K limit, or it's, other means of being uninsured?
It's over the 250K limit. So deposits that fall outside of the FDIC insurance and protections.
Got it.
And so in the case of SVB, like they had invested in all these long-term treasuries. They hadn't done any much. My understanding is they hadn't done much in the way of interest rate hedging when the Fed sort of telegraphed we're going to be raising rates. We have inflation over 9%. The rates went way up. And if you had very long-term treasuries, that wasn't good for that. And then there was sort of a communications issue where SVB came out and said, we sold some stuff, we had a huge loss, but don't worry, we're going to do something to make it better. And the market said, what? You have a plan to fix this big hole, and you're announcing you have a big hole, and given that they were the bank with the most uninsured deposits in the country, there just ended up being this huge run. So like there's been bank run ever since we've had banks, but in the digital age, bank runs can just happen at a amazing pace. And I think they lost something like $42 billion within a single day. And we had never seen anything like that. I think even like the regulatory stress tests, that's not their base case.
See, that's always my concern. The bank runs on stability. I think one of your roles is maintain stability of the market. Is there something you do to make sure that happens and it's sort of spread across all your members rather than seeing the bank run on CFPB or other banks and consolidating into, let's say 3 top banks in the United States?
So the role of the home loan banks is to try to provide liquidity so that when members need funds, they have them. So the way the economic cycle works, sometimes banks are flush with deposits. Other times, people need their funds and take them out. And this sort of creates like a market failure where a bank may have somebody come to them and say, hey, I need a loan to get a house, or I need a loan to start a business. And the bank would love to lend them the money, but they don't have the deposits. And so we have this system where we have a willing lender and we have a willing customer, and they want to do something that would be additive to the economy, additive to them, but the funding doesn't line up. And so the home loan bank system is there to correct this market failure and to make those funds available so that this transaction can occur. And essentially the role of the home loan banks, we're connecting capital markets with lenders and with borrowers at the end of the day. So the system, I mentioned before, we have the Office of Finance, which is based outside of DC here. So the Office of Finance is the capital markets agent for all of the 11 federal home loan banks. And they issue consolidated obligations in capital markets. Investors then that have funds to deploy will invest in federal home loan bank debt, which is then, those funds are then provided to the member banks, which are then provided to the members. And so if there's a deposit, a mismatch between deposits and demand for funds for loans, and we then connect capital markets to the member. And this is
Is
particularly
it a similar?
mentioned before.
Yeah, John, is that a similar to like a treasury auctions where investors can pitch in?
Yep. Yeah. So we have a posted auction schedule on the website of the Office of Finance. So there's some things happen just as they come about, and we have scheduled auctions as well.
Okay, makes sense. So can you also put some color on the number of banks that are paying back on the advances from 2023? Do you see that number going down, or you actually see a flat line that the banks are still in need of that advance to survive and wait it out until, I guess, the rates will drop?
Yes, that's a great question. So actually, I just spoke with a small member from Alaska the other day, and he was saying that they took out funds back in March, and they're still holding them on their balance sheet just to make sure that they have the funds there. They said they probably don't need them, but just to shore up their position and make sure that in case somebody does come or something happens, they have that liquidity there. And so you also touched on something that's really important. So the role of the system is sort of to be a to be a sort of a rubber band for the system, and we can expand and contract based on the demand. So in 2021, like after COVID happened, and there was this huge flow of stimulus from the federal government, that everybody received all these checks, people deposited all these checks in their bank accounts. So a lot of banks had an abundance of deposits, and Federal Home Loan Bank debt ended up going down. Our advances went to a 15-year low at that time. Since then, the COVID funding has sort of finished up. People have spent those funds, and the demand for advances went back up. And then, as I mentioned before, in the spring of 2023, we had a record high in the amount of advances outstanding. And so we crossed $1 trillion. So it's a huge money, a huge amount. So we had over $1 trillion in the first quarter of 2023. By the end of 2023, by the end of the fourth quarter, our advances outstanding were below where we started the year. So there was a huge demand in the stress periods in March, April, maybe even into May. After that, things calmed down, and a lot of those advances were returned.
Okay, that's interesting to know, because that shows the stability of the system itself, right? So
Right.
all of a sudden, everybody panicked. All the banks panicked. They borrowed money and they returned it. And now I assume that the interest rates that they use to borrow the money, or that you charge to borrow the money, is in line with I guess, Fed's interest rates. And then, is there in your mind a way they can leverage this advance to arbitrage the lending, as they did with Feds, and that's why Feds, I guess, closed the bank fund term fund program, right? Because they were afraid of arbitrage. Do you see the same issue when you do an advance?
Not that I'm aware of. Like you mentioned, during last spring, the Fed set up the bank term funding program, and I think that was definitely a huge help in stabilizing the system. Like, it didn't get a ton of use, but just knowing that it was there, and that if a bank had held to market, held to maturity securities that had declined in value, if they needed the liquidity, they could use that facility for that, I think was very helpful. Like I said, like at the end of the first quarter last year, we had more than $1 trillion in advances outstanding. Bank term funding program had $64 billion at the time. So you can see the size and the scope there. And then
maybe, John, let's maybe take a step back, and that's a good topic for understanding. what's the difference between Federal Reserve lending versus you? Are they coming to you first or Feds first? How do you play with each other, and what is the waterfall of the bank in distress to knock at the door of Federal Home Loan Banks versus Feds before FDIC will start looking at them and sort of considering them for receivership?
Yeah, that's a great question. So I think the Fed has always been known as the lender of last resort. The Federal Home Loan Banks, some have called us the lender of first resort. So the Federal Home Loan Banks, so like as of right now, like I said, we have I think around 3,700 members that have advances outstanding. And we have at last call, it was over $800 billion. So there's a lot of people who are using our funding for their routine operations or for cash flow management when deposits go down and they still want to provide lending in their communities, they will come to the home loan bank system. The Fed, again, is sort of considered this lender of last resort. So when people really need the funding, and so the home loan banks as well, if like we're a collateralized lender, so you have to post eligible collateral. Most of our collateral is like single family loans or multifamily, things like that. If you don't have eligible collateral, or if you're not a member of the Federal Home Loan Bank system, then obviously you can't get access from the system. Similarly, the Fed discount window, you need to have all of your steps in a row for that. The Fed discount window, I think, is open to banks and to credit unions. So the home loan bank system as well has CDFIs, insurance companies, other members that maybe don't have access to the Fed, so that's not an option for them. But we generally try to work with members. If a member comes to the home loan bank, says, "Oh, I need to have my discount window access, but I don't know exactly how to do that," we'll work with them to set that up so that they have that as a resource as well.
Understood. So really, John, if just to rephrase, if I'm a bank in distress, first I knock on your door, I say, "Here's the collateral that I have. Can I borrow against it?" And that's my first step. And if it's not enough, I knock at the Fed's door and I say, do we have any, at the discount window, do we have any funds to allow me to operate as normal, to avoid any failures and to guarantee stability? And then if I recover, I pay back you first to get the collateral back, right? And then the Feds.
Yes, and that's sort of how it works. So I remember when I saw a statistic for, I think it was First Republic that failed last, I think May 1st. And at that time, they had advances from the home loan bank system. They also had advances from the Fed as well. And their Fed lending, I think, was 3 times as much as the home loan lending at that point in time. So obviously they were in a very stressed condition and had gone to as many sources as they could to try to get themselves through that period.
What is the typical timeline to receive the funds? So in other words, assuming that they have a perfect collateral that you require, they went through the checklist and they knocked on your door to getting the money. What does that process take? Is that a few months? Is that can be done in weeks?
It's normally in days.
In days.
We have very fast turnaround. So the system. So each bank is doing is reviewing a member's overall sort of credit status on a routine basis, and then they can pre-position collateral as well and say, here's the collateral I have, and as once that's in and once that's been checked, they can get the funds very rapidly.
And you touched on insurance members. As opposed to banks, they don't have access to Fed's funding. Do you see insurance companies in distress? Especially, it worries me because they doubled the rates in many places. They exited Florida and California. Do you see distress in that market as well, or you think they're stable and they can still provide the insurance service across U.S.?
I haven't really looked into that, so I don't really know much on that. But like you said, with the way we have these sort of erratic climate events and things, and then ships running into bridges in Baltimore, it's not a great time for the insurance industry, you would think.
Yeah, exactly. I would expect them knocking in your door very soon because it's just too much loss going on with the natural disasters, with fires in California, with the Hawaii disaster. It piles up, and maybe they're well funded. I just don't have any feel on the distress level.
Mm-hmm.
But let's switch back to banks. If you look back at 2023 again and evaluate the lessons learned from all the bank failures in the March, May of 2023, what would you recommend for the banks to do? What would you do different from the perspective of, avoiding this run on the Fed, I call it, right? Run on the Fed or run on the Federal Home Loan Banks. What do they have to have ready to make sure that with the push of a button, they can ask for money and, like you say, get it in days?
Mm-hmm. Yeah, so I think for me, the lessons from last spring are the importance of liquidity, collateral, and coordination. So the system, like we had these bank runs and this fear of contagion, and that just resulted in this huge demand for liquidity. And the home loan banks stepped up and met our mission, served our members, provided just, like I said, like $675 billion in advances in a single week. And it was again, the focus is always on who didn't make it out, but 99.5% of the members did make it through that period. And I remember a bunch of the members that were on those lists of, here's the list of who could potentially fail next. And we saw advances going way up, and then they've come back down, and they're still out there. Our employees are still employed. Their customers are still being served. So there's lots of success stories, but it's hard to focus on the banks and the insurance companies that are still there when you have a few that disappear. And then again, coordination is really important. So after last spring, there was a lot of articles and talk about, well, there's issues with coordination. The Federal Home Loan Banks need to work on coordinating. So during that period, the local banks that were involved, many of them were having discussions daily or multiple times a day with regulators to coordinate action. One of the things that's in the statute for the Federal Home Loan Banks is that if a primary regulator says our entity is really in trouble, we don't want you doing anything more to them, then we have to stop. So if a regulator says don't lend to Bank X, then we don't lend to Bank X. But at the same time, sometimes the regulators come to us and say, Bank X is in trouble. We need some more time to figure out exactly how we're going to resolve this. Please keep lending to Bank X. And so we work with FDIC, we work with the Fed, we work with the state regulators, and it's a very important part of the way the system operates. Unfortunately, a lot of that is it's regulatory and supervisory, and so we can't talk about, okay, Bank X, we were there on this day, we talked with the Fed about this, talked to the FTC about that, talked to the state regulator about this. So a lot of that is, again, privileged discussion, so we can't talk about all of those things in detail, but just know that there's a lot of coordination going on, and like to get through the spring of last year, all the regulators really stepped up and took the steps needed to get us through that.
Yeah, that was amazing to me as well. I was in the camp of, oh my God, we're going to see hundreds of banks failed, and this is just the scratching the surface with two major failures. And I was in the same camp because I saw the stress. I saw people are, running for the banks, tried to get the money out, or moved at least. Everybody moved to a larger banks that they thought are stable, J.P. Morgan and Bank of America of the world. But it seems like it's stabilized. So I'm very, very impressed. I guess it speaks volume in what you guys do together with Feds. But this year, I'm again stressed. Jerome Powell comes out and says, I expect 200 to 300 or several hundred banks to fail this or next year because of the interest rates staying higher for longer. And that makes me stressed. That, again, I see the issues with the market. And I do see some cracks, and I would love to get your opinion on the current economic outlook for 2024, with respect to everything that's going on with all the issues. And you are in the perfect seat to know how bad is the stress level this year.
So the market right now doesn't seem too bad, I don't think. But we're in this sort of higher for a longer period. And the market consensus has been wrong for a long time now. I think the only consensus is that the consensus will always be wrong. And so there are people are saying that there were going to be multiple rate cuts last year, and then rates by the end of the year, and then rate cuts by March, and then May, and now yesterday President Bostic came out and said, I don't see one until fourth quarter. And the Fed has traditionally not been anxious to cut rates during a presidential election cycle. So if we get past July, what does that mean? The next FOMC, there's an FOMC in September, and then the one in November is the day after the election. They don't like to take policy when there's uncertainty, and there's going to be crazy uncertainty in the market at that time. So I don't necessarily think the interest rate outlook is all that great for 2024. And that makes it difficult for banks. Like, we have this inverted yield curve, and banks tend to take deposits and on the short end and lend on the long end. And when you have an inverted yield curve, that makes for a really difficult business environment. So like you were saying earlier, the thing that's great about the system is that we have this diversity of members and that we serve all the members. Like, we do have, like, JP Morgan is one of our biggest members, and we have a number of really large members that are very active in the system, and that allows us to be active in capital markets. So the markets know that the home loan bank system will always be there in terms of investable assets. So we have that regular market presence helps us to have low cost of funds, which we then can pass on to all of our members. And so, like, while JP Morgan can go and access the capital markets on their own, the little mom and pop bank in whatever, Salinas, California, they don't have that clout. And so we're then passing on the low cost funds that we can provide due to the presence of our larger members, but we can provide that for our smaller members, which levels the playing field. And so, like you were mentioning, bank failures, like, I think I saw a report that like there were 8,200 FDIC insured banks in 2000. We're now less than 4,200. So there's been 50% consolidation in that 22 year period. And every day, every time I hear a CEO talking, it's normally, oh, we're about to merge with this bank, and we're going to merge with that bank, and these guys are coming together. These guys are coming together. This one's whenever there's a financial crisis, it seems like JP Morgan swoops in and ends up absorbing somebody else as well. So we end up, the bank consolidation, I think, is a trend that's been happening for a long time, and it's probably going to continue to happen. The Federal Home Loan Banks, I think, definitely help to slow that by providing sort of a level playing field and allowing the little guys to compete with the big guys. And having those little guys is great for consumers, because big guys, by their necessity, have standardized products and standardized business lines. The little guy can say, okay, what do you need? What does your business need, Alex? And I can help you to produce that. Or what kind of home loan do you need? Is there something that's not being served by the general market or the conventional market overall? How can we help you and fill that gap?
Do you see a stress of the CRE market? I mean, it seems like you're describing a very stable system, but again, with interest rates staying higher for longer. And I'm actually in the same camp as you. I don't see rate cuts this year at all. In fact, I projected that at the end of last year, and while market was expecting 6 to 8 cuts, and now they're expecting, what, 2? I think they're wrong. I think, the inflation is still hot. The employment is still low. So we're not hitting the Fed's targets yet. And like you said, at the election year, if there's no cuts in the summer, you're not getting the cuts prior to election. So in this scenario, it's the commercial heavy loaded banks, commercial loan heavy loaded banks will see the most of the stress, just because of vacancy issues and and the valuation of 50 cents on the dollar now for some of the commercial office buildings, right? So do you see the CRE market providing additional stress and possibility of the bank failures this year?
I think the possibility is there. The CRE space. CRE is sort of an interesting asset class because there's so much diversity within that asset class. So right now, home prices are way up, rents are way up, and there's a huge shortage of housing. So multifamily is a portion of CRE, but I don't think that there doesn't appear to be any issues in the multifamily space. I think I saw a list posted yesterday of delinquency rates across asset classes, and multifamily was at the bottom. It was the lowest of like 35 categories. So multifamily looks like it's doing fine. CRE also includes like industrial, warehouse, self-storage. I think from what I'm hearing, almost all of those are doing well as well. Office, like you said, so we have this sort of COVID overhang and the remote work overhang, where we have offices and office properties that had high valuations before with high occupancy, and now we have lower occupancies and higher interest rates and lower demand in some urban cores. But even within the office space, there's still high demand in some markets for Class A office. There's other sections where there's going to be issues. So here, like I'm in Washington, D.C., and they were recently talking about moving the Capitals and the Wizards out of D.C. And I would think that would have been horrible for the D.C. market. But now they've just flipped it. Now they say, okay, we're gonna stay in DC. So like there's a lot going on in the CRE space and in the office space. I think we've seen some stresses recently in the past few months where some banks did have issues. Like looking across the system, it seems that most of the CRE exposure is in smaller and regional banks rather than the large banks. And those smaller banks are also the ones that tend to have more liquidity issues. There was an Urban Institute paper that came out last year that showed that access to the Federal Home Loan Bank system was really critical, especially for those small banks, less than $50 billion in assets, and that the failure rate for those small banks that did and did not have access to the home loan banks, that there was a market difference there. And so the home loan bank system is doing our part to try and provide liquidity and stabilize those small community and regional lenders. I think you mentioned before, there's risks out there and there will be some distress, and one person seeing something as distressed and problematic will be an opportunity for somebody else. So I think probably overall the economy will be fine, but there definitely will be pain points here and there.
Yeah, I can echo that. First point is that I just interviewed this week Darren Woolquist from Option.com, and he confirmed the same thing, that he doesn't see on his analysis the multifamily as delinquent asset class across the board. It's the last one on the list. It's almost, non-delinquent. Rents are up and people are paying. The only problems are for variable rate commercial mortgages and multifamily. For those big funds where they didn't log the fixed rates, then they get the capital calls this year based on the maturity of the CRE loans. But other than that, multifamily is doing great. The second point is, like you said, the small institutions. I think if you stabilize that market, you potentially should see very little, if none, banks fail, right? And that's a troubling sign, because you don't want to see folks running or taking their deposits from small banks to larger banks, and they will definitely suffer on amount of assets and not have enough, I guess, deposits to lend back on the market. And I guess the final point on the capital markets, I can tell you that all my clients have a lot of dry powder. So they're waiting, like you said, for the opportunities to jump in and do something in that failed commercial market. And they're just waiting for the assets to come through, either through FDIC structured sales or some sort of a capital market transactions. And certainly the money is on the sidelines. So waiting for some sort of an event to jump in and invest and then sort of revive the commercial assets. So John, I know we touched quite a bit, right? And I would love to talk more in 4 hours. You are very, very knowledgeable. I would love to bring you back towards the end of the year and see how you weathered the storm of higher for longer interest rates, and we can recap this conversation and touch on whether or not more banks failed, and whether you or I were right about our views on the current 2024 outlook. So I really wanted to thank you for coming into the show, and hope that all the audience learned quite a bit about the Federal Home Loan Bank system, what it takes and how it operates. Again, thanks so much, John.
Thank you so much. It was a pleasure.
Absolutely. Thanks, and everybody, goodbye.